Attention A1 Trading Show fans. If you're looking to get funded, we've got a solution for you. Our partnered prop firm FX2 Funding helps traders get access to up to $200,000 in trading capital. FX2 Funding is not your average prop firm. We've chosen them as our partner because of their fair examination rules, their professional and available customer service, and they have an outstanding reputation in the prop firm space. Here's a quick look at their evaluation process. First, they don't have a time limit on their evaluations. That means that you can take your time when passing your evaluation. There's no pressure to rush your trading. Second, there is only one phase to pass in their evaluation before getting access to your funded account. Also, their evaluation fees are fairly priced and fully refundable upon passing. Once you're funded, you'll be able to keep up to 85% of your trading profits. Finally, a rule we know swing traders will love: you can hold your positions over the weekend. For a limited time, get 15% off any of their account challenges with promo code A1Trading15. That's 15% off any account challenge with code A1Trading15. If you're ready to get funded, we're dropping a link in the chat right now, and you can also find it in the description down below. So go ahead and get signed up today for 15% off with promo code A1Trading15. Now, back to the show.
All right, everybody, welcome back to another live stream. A pretty big one today, of course, probably one of the biggest ones to end out the month here. We do have, of course, the Fed interest rate decision, as well as their statement and press conference here in the next hour. Should be a pretty action-packed experience, and with that, I've recruited some help, or my team has put together some help. We've got Chris Pulver joining us today on the show, and you guys who know him will have always, of course, enjoyed his commentary, as I do myself. Just a quick rundown before we jump into that. Of course, what are we here for? If you're a newer trader, there's always people in the audience who are, just figuring this stuff out, and if you're new around here, then welcome, first of all. But second of all, again, we are here for the Fed funds rate decision coming out at 2 p.m. U.S. Eastern. That gives us about 15 minutes, actually less than that now, to prepare for this event. It is currently expected for the market to see a 5.5% interest rate handle here in the United States. That's up 25 basis points from the previous rate at 5.25%. Previous time around, they kept their rates unchanged and made mention to perhaps one more rate hike. Well, actually, there's more to that. We'll be talking about that here today with Chris as we get started. I just want to show you guys just currently where I'm at personally. I have no open short-term trades on going into the release. I don't have a NASDAQ trade. I don't have an S&P trade. I did trail out of my NASDAQ trade for a profit, which I feel like I was in, glad to have done that. I ended up catching this this move here. This break of this trend line. I dropped down to the lower time frames. It was really a 30-minute chart setup. I picked this thing up on the long side over here. And as it popped like this, I actually trailed my stop. Now, I did get stopped out here and trailed it for a profit, of course. So I did make some money on this. But honestly, I'm just going to call it good there and wait for the dust to settle a little bit here. I'm not really interested in taking a trade right before the news. But of course, that's what we're here to do. We are here to talk about the news. We're here about talking about trade setups and ideas as we get into, of course, the Fed interest rate decision. So joining me now, we're going to bring in Chris Pulver to take a look at the markets and to ask him his take. Let's just bring him in and we'll say hello to Chris. Hey, Chris, how you going? How's it going, man?
Good. What's up, Nick? How's everybody? Happy Wednesday.
Good to have you. Yeah, good to have you back on the show. And just a quick introduction for people who don't know you. Chris Pulver has been coming on the streams here for these Fed meetings the last couple months, and always good to have his commentary. Chris has been trading in the industry for a number of years as an educator. He also is working with some hedge fund stuff, which is really exciting as well. Money manager, a trading educator. Your past precedes you, man. So we're happy to have you on for some more commentary about the Fed. Chris, what are you looking at here today? And I guess, how are you approaching this? Are you as cautious as I am? We've had a great run up in the stock market. Lots of bearishness on the dollar. Overall, dollar's been rising a little bit. NAS has been up, pulling back here. Are you approaching this as cautiously as I am, or do you have any trades on? What do you think?
I do have a trade on. I'm essentially hedged on the SPY. I'm trying to think last time we did this and we did a rate decision. I was hedged and it played out nicely to, one side winning, one side losing. I've got the same situation playing out this morning. I have some option trades going on the SPY. I went out to tomorrow's expiration because if you looked at the last few days, Friday, Monday, yesterday, we've had minimum movement. It's been only a couple of dollars up and down in the SPY. Qs have been pretty quiet. I think that this meeting is coming at a pretty good time where, technically I'm looking at the charts and thinking we should be getting a correction. Again, if the technicals play out, we should be getting a correction. I talked about levels this week in my trading rooms. If the SPY dips to 445 or lower, I'm interested in putting on option trades for the rest of the year going bullish. If the Qs pull back to 370 or lower, same type of thing. I think this market is going to take the Fed meeting, and we'll find out, obviously. But the Fed is going to deliver another hawkish message. They do not want to give any explicit detail on cutting rates or giving the market the chance to kind of price in ahead of time. Inflation could remain sticky. They can have this very hawkish message coming from Powell. I just think that it's at the right time to see a necessary correction technically. But I don't think it's going to be very big. If we get a 3 to 5% pullback, that might be all we get. If the market's going to remain bullish and remain pretty optimistic by the end of the year, we've had a lot of big swings in sentiment. I mean, I'm sure I know you watched that with your EDGEFINDER tool. We've had way more greed out there, way more optimism out there. And I think that everyone that was, fleeing to safety is now looking to participate and try to find some type of rally left in the market for the second half of the year. So I think dips are great. Dips are great, but I'm buying dips, man.
Yeah, I'm with you on that, Chris. I mean, my thought is, I've been a bull for a while, and I will say that proudly because I was very right this year. I was very wrong last year. So if you're wrong one year and you're right the next, you get the right to tell everybody when you're right, as long as you mention when you're not so right. Last year, I took some beatings, trying to trade indices on the long side. I've talked about that on my channel a good bit, but this year we've been very right. And I'm along the same ride as you. It's one of those markets where every dip is getting bought. And we saw this big time in 2020, 2021. It went away for a while, which of course, again, that's kind of how I got burned. You get what happens is you get addicted to the sauce, when it's working so well. Well, I should say, Dick, I stuck to the rules, but I didn't have the right filters, I think, to get me to be more hesitant on the long side during market sell-offs. But anyways, that's another topic. I'm with you on that, Chris. I think, pullbacks for the time being, we have a very different scenario than we did a year ago, right? We don't have a Fed that is pointing to just, unlimited rate hikes going forward until they see, with that uncertainty. And that's that word that market participants hate. They really hate uncertainty in the markets. Right now, we've got things headed in the right direction. And the only uncertainty we have is, are they going to do one rate hike or two? But things seem to be going in the right direction. And so the market loves that. So that scenario, that economic situation, that fundamental playground, I think gives you some opportunities to dip by as well. You mentioned on the higher time frames, probably the daily chart, good level there that I liked a lot as well. You have 44.50 on your chart. That's a pullback down to this key level here. I like that as well. There's that zone that you mentioned, that 44.50 zone. That's a pretty significant, I shouldn't say significant. It's a reasonable pullback. Probably healthy for the market to have one of those, right? We haven't had significant pullbacks since really kind of June, and even beyond that, there's been minor pullbacks. But again, I think at the same time, Chris, the way I'm looking at it, and you probably yourself as well, that pullback, if that comes in, you got to be ready to take that jump because this market doesn't give you too many opportunities. So if it sets up, you got to make your move, I think. So what do you think? So you got S&P. You trading anything else? NASDAQ?
I'm looking. Yeah. So what I did today is I put on basically a straddle. So I'm looking at a long straddle. So I have a long call, long put, and I'm looking to basically let volatility lead me to profit today. I'm looking at a 2.5 to 3x return on those positions, which would give me a net profit for the overall trade. That's going out to tomorrow's expiration. Going into the rest of today, I mean, amateurs open, pros close, 2 to 4 p.m. should be pretty volatile. I'm going to follow the NASDAQ. I'm going to follow the QQQ and the SPY, and I'm going to see if I can look at something that same day expiration and try to grab a little grind today. Neither one of the ETFs have hit any of my big levels today. So it's been quiet. Like I said, Friday, Monday, Tuesday, today's Wednesday. I think the Fed breaks open the volatility floodgates a little bit. So to the downside, I mean, I'd love to see a move on the Qs down to, 372 or 371. And if we want to
Mhm.
rip higher, I'd love to see this thing go back and retest 380, 381. So somewhere between $4 and $5 on the Qs, or maybe a $4 or $5 move in the SPY. That would just be volatility opening up for the first time in 4 days. So that's what I'm looking
Yeah.
at short term today.
Yeah, no, I like that. And Chris, for me too, I'm watching the NASDAQ pretty heavy. I am just eyeing this level. I've got the futures version, NAS100, pulled up just for
Okay.
reference for some of our international friends. 15,200 is a level that I like. I'm not sure where the Qs, you said QQQ 380, is that what you said? So, or did you say 360 on the Qs?
81 to the upside and 370, 371 to the downside. So it's about
Okay.
it's like a
Yeah, yeah, yeah.
1.5 to 2% move either way.
Okay, yeah, so that's probably right around the same level that I'm talking about when looking at NAS. For those of you guys
Yeah.
who are a bit confused about that little last segment there, of course, there's differences if you're trading the ETF, which is the Qs, QQQ, as Chris mentioned, or NAS 100 or NASDAQ futures. It's all the same thing, just different sometimes price quotes. But
Right.
anyways, yeah, I mean, the moral of the story is I think dip buying right now is the path of least resistance, unless we get something catastrophically different from the Fed. Chris, we've talked indices here. We've got about 4 minutes before the release. We've talked about this pretty much every Fed meeting. The price is pretty much expecting one rate hike here, 25 basis points. The more important stuff is as we talk about that forward projection. What do
Right.
you think? Have you looked at any? Are you trading any currency pairs right now? Are you trading any dollar pairs?
I'm minimum on the dollar. I told traders this week in the trading room, I really like, if we see dollar strength, and this is one thing that I was a little careful on the last couple of weeks, is look at the difference between US dollar and
Mm,
DXY. If you look
mm,
at those charts, the US dollar, the FXCM US dollar index, it held beautifully at that support level, and the DXY made a little bit of a turtle poke to the downside. So,
mm.
today's dollar strength would make sense. That gives us a pullback. It's summer trading, it's range trading. So I could see dollar strength being the byproduct of today's Fed meeting. And that just gets us back to range levels. I'm still medium term to long term bearish on the dollar. I think that in order for the stock market to edge higher and energy and commodities to edge higher, the dollar is going to have to be the sacrificial pawn essentially.
Sure.
But coming into end of July into August, probably one of the slower times in forex trading and seasonal times in the markets. I could see the dollar catching bid and maintaining this little drift back to the upside in this correction. It was
Yeah.
pretty crazy how the dollar fell so aggressively. So I have dollar Swiss exposure. That's kind of a carry trade opportunity. The trades that I like on dollar right now is if the dollar CAD breaks above 32.50. I think 32.50 upwards to 34.50. I like that trade. I think pound dollar, if we get another little break to the downside, has room to drop to 24.50 or even 1.20 if the dollar really catches some strong bid.
Hmm.
That's about it. Euro dollar you could lump in there, but I think to me the cleanest trades right now, dollar CAD long if we get above 32.50, and a pound dollar with a little bit of a push coming into dollar strength.
Yeah, Chris, that concept. Look at what a pretty chart there. That pound USD here. I've got it pulled up after you mentioned it. You have this almost. This looks like you pulled it out of a textbook technical analysis, for a beginner's
Right.
sheet. I mean, this is perfect because you have a past level of resistance here that got hit, gave us some trouble here in June. July, the big breakout occurs. CPI numbers push the pound down, had a little bit of slow on the PMI numbers, but then again, a little bit of dollar weakness. Any sign of dollar weakness, as you're pointing, could give this pound another leg higher. And
Mhm.
I think the risk reward here looks really interesting on the pound. Of course, we've got about a minute and a half here before the numbers come out. But again, we'll get perhaps some signaling here today with Fed commentary, that sort of thing. But yeah, any sign of dollar weakness, pound USD looks very interesting there to the upside. If this thing wants to get going, you have that previous high right around 1.31 to come into play pretty quick, and beyond, especially for the swing traders out there. But even the day traders, you have that daily chart. Sometimes people say, "Oh, the daily chart that's only for swing traders." Well, day traders could take full advantage as well. You get down in the lower time frames and say, "Hey, there's that daily zone. These beautiful breakouts are occurring." Maybe looking for those dip pullbacks, and probably should rise with the indices, right, Chris? I mean, pound USD, as you mentioned, that dollar weakness that could come into play could be interesting. We'll come back to that topic. Let me not mess up here. I've been victim of getting too far in a thought. We've got about 20 seconds here to go before volatility hits us. So we've got our breaking news coming out with the news. I've got gold, the bottom left, pound dollar, euro dollar, and I'm just going to throw up the S&P 500 here. bottom right for us to keep an eye on going into the news. So we got our breaking news happening right now. All right, let's see if any surprises. I mean, it would be very surprising if we do get something out of the expected, but just want to watch the reaction here. Got pound initially making a slight move down, pound now making a move back up. And again, Chris, we've had this conversation several times, but usually the result of this opening candle to this news hour is usually kind of an ugly one.
Yep. As expected, rate hike was 25 basis points. This is what the market priced in. Nick, I wanted to ask you, so if you look out on the CME Fed Watch tool, if you look out to like November, December, there's a little sliver of potential that we might see another rate hike by the end of the year. Again, I think the Fed would be more explicit on additional hikes to kind of, tone the market down and get them less excited. But the Fed's going to be very silent when it comes to announcing rate cuts. I think the market's already pricing in rate cuts or looking ahead that, March of next year, December of next year, we're going to be roughly 1% lower than where we are right now. But I am curious if the Fed, I saw, if you look at the website Trueflation, last week, I think I posted this in my Discord group, 2.11% was the US reading on true inflation and core levels, and it's back up to 2.5. So I do think that this like 2 to 3 to 2 to 4% window could be very sticky for the U.S. to really get us below that 2%. We have a lot of deflationary pressures, but obviously we've had a great improvement from 9.1 down to sub 3. And I'm just curious, I think the Fed's message will stay hawkish and they're just going to try to tackle inflation, get this restrictive rate going. But what I'm saying is, do you think that the Fed, November, December, there's a possibility that they might really kind of crap on the market by having another rate hike? Those are the only 2 months that I see that maybe have another 25 basis points in.
Well, that's the question, right, Chris? Because one thing I will say that I'm thinking about is the Fed has made it pretty clear. There's a couple problems that they still have and why they probably stay hawkish is unemployment has not cracked. And, historically, a really strong labor market makes it so that inflation problems don't just go away. They're in fact just going to keep creeping up until there's a little bit of looseness or softening on the labor market. Labor market is just so tight, and so I think that part of their goal. And again, I'm by no means the expert on this, and projections on the Fed Watch tool are going to be of some of the highest quality out there. They're not perfect, but of course they're take into account a lot of traders' opinions. I think the labor market will be interesting to watch, because if that labor market doesn't show any signs of cracking, like you mentioned, that stubborn 2 to 4% ratio is going to be very difficult to on the inflation rate is going to be tricky. So it's that side of things, and then there is also the problem of housing in the United States. It's a big thing, right? You have actually we had some housing numbers earlier kind of moved the market, but there's several things that the Fed is juggling. And if they're still kind of, pointing towards more hawkishness, you do have to be careful. And that's why the markets are expected to be volatile today. The old adage, don't fight the Fed, is a real thing. And if they see problems and they see, the need to continue rate hikes and they make mention to that today, that's why personally I'm kind of sidelined with most of my positions. Sure. I'm not always that case. There are plenty of times where I hold into news, but again, today, just with that predicament, I think the market is so optimistic. You just have to be a little bit cautious with that. What do you think? Turn that question back to you.
Yeah, I think that, like I said, they're going to be very vocal about being hawkish, and they're going to be dead silent when it comes to being dovish. Part of me wonders if the reason that the Fed starts cutting rates in the future is because something breaks. We still have this crazy deep inverted yield curve where the 2 and the 10-year treasury are above 1% inverted. We still have a bond market that has tested lows because the yields remain sticky and high. The 60-40 portfolio, the bonds versus equities. Right now it's all about equities. It's all about this rip higher. It's all about this FOMO. It's the S&P 7 and it's the NASDAQ 7. Right. Yep. Nothing else is really leading the way. So, I think we talked about this in the last couple of sessions we've done. Are other companies going to step up to the plate and pick up the market breadth, or is this going to be just a slow grind higher? I'm just curious, how much optimism is in there? When the dust settles today, if the market is higher, to me, that just tells me that there's more optimism and there's more greed out there that's just going to drive prices higher, and the Fed can do very little to stop it right now. And so, again, I would say, this is an interesting stat. So we've had the best start in equities since 2019, and the last start before that for the first half of the year was 1989. So you've had
Wow.
2 better starts than 2023. But the way that those years finished was really interesting because 2019 just barely creeped ahead. Like we finished, 20% first half and like 8 or 9% second half.
Yeah.
1989 was, a 20+% first half and like an 8% second half. I think 2013 was another year that had like a 17-16% first half and finished like single digit second half. So I just wonder if like the momentum's been started, it'll carry and drift and not really derail, but it's just going to be less of a lackluster run than it was the first half when it was like just pain trade was FOMO all year.
Yeah. Well, Chris, I mean, that's kind of where I'm at too. You look at it and you just say, well, how I'm not one to say, oh, it's gone too high, let me short it.
Right.
But I'm definitely with you on the side of like, let's be cautious. And for me, there's some plays that I'm doing, right? I mean, I'm still looking to buy indices on pullbacks, but I'm keeping those stops tight. I'm letting them, I want to, be out of the trade if we get big sell-offs, but I'm also doing things like I'm selling calls on some positions that I have, covered calls. So, that sort of thing. So I've got covered calls on a lot of things. I'm, if I do want to enter an indice right now, a lot of what I'm doing, I'm trading, NAS100, but I'm selling puts on the Russell, pretty out of the money, and some things there. But yeah, I think proceeding with caution is big, and I don't hesitate to kind of, if something runs real strong, I'm looking to trail out of it pretty tight. Like I don't want to hold on too overly optimistically, and I think that's important. To point out. So, Chris, I do want to say we've talked about this several times, but for people who are perhaps newer in the audience, so we had the 2 o'clock release. This is the, of course, the interest rate decision for this meeting, right? We had the 25 basis point rate hike as completely expected. That's why, guys, you get these moves where it's like shoot in one direction, go back in the other direction. Right. Or, when you pull up the NASDAQ or the gold market, right, you're getting some of these moves that jolt back and forth. Like here's a great example on gold. Chris, for newer people, why is it that the 2:30 meeting and statements themselves are more important than the news drop of the rate hike decision? Walk us through that for maybe people who are newer to the audience here.
Yeah, that's a great subject. So a lot of times there's a saying that's buy the rumor, sell the fact. Or this case, we've had months anticipated that the Fed would raise in July, right? They paused in June, but we've been on a, out of 16 or 17 months, we've had a rate hike almost, every quarter of those last couple of years, which has been one of the most aggressive in history. So going into this pause we had through June, it was much anticipated there'd be another kind of final raise for the Fed. So what did the market do today? Or what did the Fed do today? They did exactly as expected. The transparency in the Fed is kind of impressive. The Fed Watch tool we've referenced, the CME Group Watch tool, that has not been wrong going into a Fed meeting since 2009. So if you want to see what the Fed's actually doing, that's a good tool to watch and see like where those probabilities are baked in, because there's probably not a lot of surprises. So I'm looking at it right now, Nick, on my screen. And like I mentioned, there have been some shifting around in that November 23 and December 23. So later on this year, we're still looking at the market anticipating the highest probability is going to be a pause. So earlier today, I think literally my live sessions this morning, it was like 35%. Like, would they raise rates 25 points or would they keep it the same? And now it's 60% probability they're going to keep it the same. So something about today's language and FOMC statement is telling the markets we're just going to keep pausing, be higher for longer. And now let's get to the press conference. This is where the market's trying to anticipate or basically calculate commentary, right? This is Powell's press conference where he can say something that for some reason the market doesn't want to hear it and it's going to drop, or he can say something the market loves to hear it, the market can rip. So it just, again, we kind of have like all these massive pockets waiting on the sidelines to drive price. And I think one little catalyst could be hawkish or dovish or bearish or bullish. And I just think it's important that if you're trading today from now until 4 p.m., for me, I am just sitting on my hands, waiting for some price action to come very clear to me. And then I'll look to see if I have something lined up short term. But I do think today, if we have another quiet day, that's going to be a disappointment to me price action wise, which is why I priced out some of the straddle that I did. I priced it to tomorrow. I do think we can have more movement than just a couple dollars. I think it's ridiculous if we only move that much.
Yeah, no, that's probably fair. And again, that's why, as you mentioned there, that's so important to note that the 2 o'clock landing is, as you mentioned, as expected, as it has been for several years. They're very, very transparent lately about what they're going to do. It comes out as expected. And that's the old adage, don't fight the Fed. It's because they tell you a lot of times, at least reasonably recently, they are pretty accurate with what they say. So will be interesting to get that commentary here in just a little bit. Chris, I won't keep you hanging on for too long. I want to thank you, and we always appreciate having you on the show. Before you step off the show, let me just remind everybody in the audience, Chris is somebody that I really respect, and really he's been in the market and been in the trading education space longer than myself, and I always appreciate having him on the show. If you guys would just make sure to take half a second here, go subscribe to his YouTube channel. We've just had it dropped in the chat from our producers. Thank you guys for sharing that link. Chris, we just dropped your link in the chat. Is there anywhere else you would like to send people to get in contact with you or follow you, or is that good?
That's a great spot to do it, because when I'm live on YouTube, I also share my Discord group that I started a couple weeks ago just to put all my content out there. So Twitter, blogs, analysis, anything I'm doing out there, it's all in one spot. So that group is growing. And Nick, I appreciate it with you and the exposure and being able to join A1 Trading. So these are always fun. And youtube.com/Chris Pulver is the best place to find me, and I'll give you all the links from there. Perfect. Yeah,
Chris, thank you very much for coming on, and we will see you back on the next one, man. See you.
Right.
Have a great day.
Thanks, Nick. Bye-bye.
See ya. Yep, always good, guys, to have Chris. Again, Chris has been in the game for quite some time. He's got experience as a trading educator. He manages money, and just very knowledgeable guy. So good to have him on the show as always. And I want to just keep going with some trade ideas here. In a bit, we'll have Frank join us as well for more trade ideas and commentary. It'd be good to hear what he's got, if he's doing any changes. Again, I have no trades open in terms of my NASDAQ. Where are we at with NAS? We haven't made too much of a move. What about gold? Gold, little bit of a pullback here, but nothing serious. I am looking for potentially gold pullbacks. I'd be happy to pick up some longs if we do get another little bit of a sell-off here. I think there might be some opportunities there. So I'm watching gold. I'm watching the NAS and S&P. Let's take a look at the S&P 500, by the way. S&P bouncing nicely off this zone of support here. But again, be careful, guys. This hour, as Chris was making a point to, the commentary that is coming, the markets can move crazy. You guys could see candles like this for the next couple hours. You don't know. You could also see a massive move down or a massive move up. So you have to be very careful when trading this, but it is expected for a good bit of volatility to occur across broad markets, whether you're trading currencies or commodities or assets, whatever. So anyways, I do want to take a look, guys. This is what I'm personally looking to trade. I'm trading the S&P 500, the NASDAQ, gold. These are going to be probably my top setups. I'm bullish on all three of these things. So watching that, for pullbacks, this is just to sum up what I am looking for personally. It's pullbacks on these three. If I can get a NAS, gold, or S&P pullback, that could be interesting. Let's take a look at retail sentiment, guys. We'll get an idea of what retail traders are doing. If you're watching currency pairs, here's where we're at. We've got dollar yen, relatively bearish. Euro USD about 50-50. Only real one on the majors is dollar Swiss. Good bit of long exposure there from retail. NZD USD, good bit of long exposure there. Aussie dollar, good bit of long exposure there. So retail kind of interesting there. Seasonal trends might be interesting to pay attention to. If you guys are watching things like the euro, pretty flat for July, August, not too much of interest here. Let's see if we can find something. We also talked pound USD. Pound USD expected to be slightly negative in July. It has not met up to that. August, same thing. In September, all three expected to be down. That would make sense. The September sell-off could be apparent in the stock market as well as the pound dollar, as there is usually some correlation there between pound, which is inherently a risk-on asset, compared to the S&P 500. Anyways, S&P has been real rock solid this year, as kind of expected in terms of seasonal trends. We've still got a very bullish reading in the month of July. So I'm keeping an eye on the seasonality here. Same with August. I mentioned to Chris, and we talked about that with pullback buys. I'm still very interested in pullback buying opportunities, and we'll continue to look for that as part of seasonal trends, showing us a buy reading in this case, right? For those of you guys who are confused by what I'm looking at, this is a market seasonality trend software tool built by our team here at A1 Trading. We build tools for traders. That is, of course, our primary way of making money to support these shows is we sell software tools and data for traders. We have an expectation for the month of August to also be positive. Is this a guarantee? No. It is a historical pattern that we've recognized and that we can add to our confluence. Again, that's not certainty, that's adding confluence, that's adding bias to our analysis, right? Let's take a look. So central bank forecast probably relevant to today. Again, we did actually get, as expected, the rate hike today. The question will be whether or not we stay true to projections, which if we take a look at the US, for example, US is expected to see some rate cuts in the back half of 2024, still a ways out. But as Chris mentioned in our conversation, Fed is being pretty lock and key about any rate cut decisions, as that is kind of off their scope anyways. They're very much claiming to be data dependent, watching what's coming out, and should be interesting to see how that rolls out over time. Whether that language cracks today or not would be very interesting. Whether or not they mention more rate hikes, there is still some expectation for potentially more rate hikes this year, as Chris also pointed out to us. So should be interesting to keep an eye on that. Anyways, let's keep going. We'll take a look at some more setups again. I am, being very cautious. Again, these candles are not following through very well right now, as we don't yet have anything from Jerome Powell. He will be speaking here in about 15 minutes, which could cause some good volatility. Guys, we're going to go to Frank, who is one of our traders here at A1 Trading, in just a moment. But before we do, we're going to take just a quick break to thank our sponsors here to make these shows possible. And actually, one more thing before I do that, before we go to that break, I showed you guys the software. If you guys want to try it out, if you want the free course for our software, you could get all of this. This is free resources to you. We're going to drop a link in the chat right now. This link, when you click this, is going to take you to a place where you can sign up for free information. You could set up a call with us if you're interested in doing that, to go through the software and see if it's a fit for you. It is something that we sell. We pour tremendous amounts of effort into building and designing and maintaining the software. But if you want access to yourself, if you want these reports, if you want to look at the COT data, retail sentiment, seasonal trends, and so much more, you can access all of this by clicking this link. Try it out. Click this link, fill out a form, and it will take you to get more information about the free course material that we have, the training material that we have for the EDGEFINDER, call setups, that sort of thing. All of that can be found clicking here. And one more thing, you can also direct message us. Chandler, if you would just drop that link to the direct message center as well. If you guys click this link, this will take you to a place where you can chat with a real person on our team right now. So if you want to talk to somebody about the software, if you want to ask about our discounts that we're currently running, or ask to set up a call or anything like that, you could direct message us with that link that we just dropped in the chat. And if you're watching back at a later point, you can always click the link in the description. Quick break, guys. Then we're going to go to Frank, see what he is trading here during the Fed news. So we'll be right back with Frank in just a second after this.
Attention A1 Trading Show fans. If you're interested in getting free access to the EDGEFINDER or our premium trade alerts, listen up. For a limited time, our show's partner broker 8cap is giving out free access to our products when you sign up for a new trading account with them. If you already have a broker, you may want to consider switching to 8cap because of their low trading costs, a wide range of trading assets, and their amazing customer support. If you'd like to get access to our software and Discord server for free, click the link being dropped in the chat right now and ask one of our team members for more information. Don't miss your chance for free products and an award-winning broker. Now back to the A1 Trading Show.
All right, and we are joined back now with Frank from our team here. Hey Frank, how's it going?
I'm doing well. How are you?
I'm good. Hey Frank, so you mentioned this to me this morning, 22-year high in terms of interest rates today, right? Is it 22?
Yeah, this is the highest level it's been in 22 years. So I guess the highest restriction we've had in that said time. So very hawkish environment, but I guess it's more so depending on, what Powell will say today.
Yeah, of course, we've got the commentary here in about 10 minutes or so. Frank, so of course, again, high interest rates, however, inflation moving in the right direction. I guess it's better than the contrary. If we were raising interest rates but not seeing the effects on inflation still, that would probably be a much scarier environment. The stock market would probably be back at the lows, but we are actually seeing progress there. Risk on doing quite okay here across the board. Broadly speaking, we've seen the pound catch a little bit of a bid. The dollar's been sold off. We've got of course, the stock market's doing quite well, indices. What are you trading? What are you looking at? I know you were looking at gold. Are you still in a gold trade?
Right. So I'm still in gold, holding it at like 16 or 1967. And yeah, price is just barely above it. I've been in it for a day now.
Okay.
So I'm just gonna ride that one out. In a time like this, you'd probably not encourage trading. So I guess what I'm in now, I'm just gonna hold and see where it's gonna end up going. But I'm in this, and I'm also in the S&P. That was also yesterday. So um, I guess what we've been seeing now is higher than expected expansion. The
Hmm.
Fed has anticipated, a certain amount of growth in the economy, and then it ended up being a lot more, or not a lot more, but just more than they thought. So although we haven't heard anything yet, it might be some sort of indication that either, okay, we're gonna have to stay in this restrictive zone for a while, or we'll have to hike somewhere down the road. Um, the Fed Watch tool, um, it's a really good indicator, but it's also probably going to be constantly changing throughout the day. So once we get a more solid reading on that, that would be more helpful, I would say. Um, but right now, there's just some positivity in stocks reaction and gold's reaction so far. So just looking at trade setups, we talked about this earlier on the NAS. That level coming down to support on this double top, it was around 15,280. If we can see a test there, I mean, maybe some promise to the upside, but you know, if we see a rejection from the lows today and like a hammer formation, it's going to be tough. It's going to be a tough call on whether or not you want to get in on price action or just stick to your plan. But then again, you can risk missing out. So I guess we'll just have to see. But I do like this level,
Hmm.
this trend line, and even if it touches lower to the demand zone around the double top, um, I think I would like to get in on that.
Yeah, I like that as well. I mean, the Nasdaq is hot on my watch list for sure. That 15,200 you've got marked on your chart, I've got the same thing on mine. Probably, it's had such a good run. I hear you for sure on, like, not wanting to miss out. And I did take some intraday stuff that again trailed for a profit. I think for me, Frank, too, I'm just gonna wait. You mentioned if you're in a trade, this is a situation where you're kind of trailing, you're working with what you got, kind of thing. But for me, I'm definitely looking for that deeper retracement if it happens. I'm not necessarily saying, oh, I'm going to short this thing down to that level, but I'd be interested in picking it up on a short. I'm sorry, on a deeper pullback. So yeah, should be interesting to see how that plays out. Frank, what do you think on some of the dollar pairs, like dollar yen, kind of doing some interesting stuff? Pound USD. I don't know if you saw pound dollar. It's such a clean chart right now. Like I think that's like a 50% retracement off this daily chart, or 61.8. Sorry, perfect reaction here. Any thoughts on the pound pairs?
So I do like dollar pairs. I like this setup on pound, but I haven't really looked too much into it. I've been looking at euro dollar, specifically because of their decision tomorrow morning. So they're expected to hike again. And then it's a matter of, well, what's the Fed going to do? What's the ECB going to do? And I think the US, in terms of inflation, it's much more in compliance with the Fed's interest rate hikes versus in Europe. They've had more stubborn inflation overall, and they're battling with that. So we might be looking at a more, I guess, aggressive ECB versus Fed. And then if price can hold this spot where it's at now, um, and not cross underneath that low, but hold at that zone, I think we could see some probably demand growing at some point, but we got to wait for tomorrow too.
Yeah, I think that's probably fair. You got the euro, that divergence that we often look at when talking about currency pairs. We focus really heavily, especially in the last year or two, on central banks, their positioning, whether they're hawkish, they're dovish, etc. can have a lot of impact on currencies. So Frank, you're long gold. You're waiting on NAS and S&P, similar to myself, to see if we can get a pullback. Anything else you're watching, or is that pretty much it?
Well, I'm long gold and S&P, but
okay.
I mean, I would still, I mean, talking about trade setups and seeing it coming down to that level, I would definitely want to, if I like it now, I would like it down at that level. So just honestly kind of hoping that it doesn't pull back, just so I can, stay in my trade and not have to worry about drawdown or re-entering. But yeah, so gold and S&P are my two longs right now.
Yeah, and honestly, I mean, you're looking at this level resistance 45.80 on the S&P. If that level breaks, I mean, again, to your point, sometimes new traders make this mistake of thinking something too high can't possibly go higher, right? And this is why, we focus heavily on kind of a trailing stop method. I know Frank and I trade similarly in that way, just because of the nature of us. We don't know how far something truly can go. If this level breaks out, guess what? S&P 500 could just keep running. And who knows? I mean, I think we hit recently a new 52-week high. We could potentially reach an all-time high pretty quick. So definitely interesting. And for your case, I hope the S&P keeps going. For my own case, if it does pull back, I won't mind picking something up. So we'll see. We'll see what happens. But Frank, thank you for coming on, sharing your input on the day, and we'll catch you back on the next one.
Thank you.
See ya. All right, guys. Thanks to Frank for coming on. If you guys don't know Frank, him and I actually, this is kind of confusing to some people sometimes. They don't realize we're in a studio office together. We have a trading floor and a office here in Atlanta, Georgia. So Frank and I, we work together at the same company, of course, A1 Trading, which is putting on these shows each and every day. So just a little fun fact. If you don't know that, Frank and I are in the same building. We're just in different rooms in the office. So doing our thing, trading, working on the EDGEFINDER. That's pretty much our day-to-day task. And again, other things to look at off the EDGEFINDER. We already talked S&P, NAS, gold, same story, looking for those pullbacks. Question will be, however, are there anything else? Is there anything else? Oil, slight bullish reading. I want to take a look at U.S. oil here. Oil has been actually performing quite well. I think there might be some interesting stuff here. It's not as talked about on our channels. We don't usually cover oil nearly as much as other things. But again, it's a hot market. And if it does pull back, there could be opportunities there as well. Again, look at this run on oil. U.S. oil going from 67 up to just shy of 80 in just a few weeks. What a move. So, yeah. Very interesting. Guys, comment. What are you guys watching here today? Any trades, anything you guys are watching? And of course, we are just about 2 minutes out from the upcoming Fed meeting. Somebody mentioned also in the chat that they were having some troubles clicking a link in the chat. Let's do a test here real quick. This is going to sound like I'm being cheeky. Let's drop the link to the free Discord channel. Can you guys let me know if this link does actually work? And also, if you'd like to join our free Discord, it is genuinely free. We have a free version of the Discord. Being transparent, you won't get access to everything for free. You won't get access to our trade alerts, but we do have ideas being shared, market analysis. We have free PDFs that can be helpful. So we just dropped a link in the chat. Can you guys let me know if this link is not working? But somebody said in the chat that they were having trouble clicking any of our links. So if you guys want to join the free Discord, Anna says link works. Okay, thank you. Again, let's drop that link one more time here if you guys don't mind on producer side, just for the free Discord channel. If you guys fill out this form, you'll be taken to our Discord channel where you can get access to some free stuff, free goodies for traders. It is genuinely got some free value there for you. So Raymond says Discord working. Thanks, Raymond. Appreciate you. Cool. Yeah, so we do have a free Discord. Tune in, check it out. And if you do want to sign up, I should also say, let's drop one more thing here. If you want to learn more about our trade alerts, Frank and I, who you just saw leave the camera, him and I share our trade alerts inside of the Discord channel. So for example, if I just go to a recent trade, yesterday I bought NASDAQ and I rode a pretty good move there. At one point, we were up like $885. I did trail out of that trade for, I think like $350 or something like that. So I trailed out of that trade. If you guys would like to get updates on any trades that I take, I share all of them inside of our Discord channel. But more importantly, every Discord trade alert that gets shared comes with full breakdowns and analysis. It is not just a copy-paste service. That's not what we're about. If you're serious and you're looking to learn from other people and you're very interested in trading, this is the group for you. This is not a copy and paste service. We're not looking for lazy people. We're looking for people who genuinely love this stuff. And if that's you, click this link right now. We're going to drop a link to send a direct message to someone on our support team. If you'd like to ask about membership pricing, if you'd like to see some track record results, if you'd like to just meet somebody on our team to know that we're real, if you click this link, you're going to be chatting with a real person on our staff who is here and who can help you out with a membership. Or if you want to get access to our software, just message us and someone on our team will help you out. Okay. All right. Meeting is starting. Let's do something here. I'm going to see if I can find the Fed meeting. Give me 1 second. All right, let's pull this up. I don't know if you guys will be able to hear this. We've had some issues with this in the past. Audio. Oh, I think Chandler is on this already. I think I see him. He's got audio. Chandler, do you want to share your screen and do the audio for us? That'd be awesome if you could.
And strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve.
You guys,
price stability,
yeah,
the economy doesn't work.
Let me know in the chat.
In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. Today, we took another step by raising our policy interest rate a 1/4 percentage point, and we are continuing to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Looking ahead, we will continue to take a data-dependent approach in determining the extent of additional policy firming that may be appropriate. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a moderate pace. Growth in consumer spending appears to have slowed from earlier in the year. Although activity in the housing sector has picked up somewhat, it remains well below levels of a year ago, largely reflecting higher mortgage rates. And higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the past 3 months, job gains averaged 244,000 jobs per month, a pace below that seen earlier in the year, but still a strong pace. The unemployment rate remains low at 3.6%. There are some continuing signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in May, total PCE prices rose 3.8%. Excluding the volatile food and energy categories, core PCE prices rose 4.6%. In June, the 12-month change in the Consumer Price Index, or CPI, came in at 3.0%, and the change in the core CPI was 4.8%. Inflation has moderated somewhat since the middle of last year. Nonetheless, the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher cost of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning to inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 1/4 percentage point, bringing the target range to 5.25% to 5.5%. We are also continuing the process of significantly reducing our securities holdings. With today's action, we've raised our policy rate by 5.25 percentage points since early last year. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy, particularly housing and investment. It will take time, however, for the full effects of our ongoing monetary restraint to be realized, especially on inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Steve.
Mr. Chairman, thank you. You have, I think, a couple times in your opening remarks talked about this language in determining the extent of additional policy firming that may be appropriate. Should we take that to mean that additional hikes are likely on the way? And should we also believe that all future meetings, say September and November, are live, or are you in a every other meeting mode? Thank you.
So we haven't made a decision to go to every other meeting. It's not something we've looked at. We're going to be going meeting by meeting. And as we go into each meeting, we're going to be asking ourselves the same question. So we haven't made any decisions about any future meetings, including the pace at which we'd consider hiking. But we're going to be assessing the need for further tightening that may be appropriate. You read the language, to return inflation to 2% over time. I would say that the intermeeting data came in broadly in line with expectations. Economic activity remained resilient. Job creation remained strong while cooling a bit. And the June CPI report actually came in a bit better than expectations for a change. And the June CPI report, of course, was welcome, but it's only one report, 1 month's data. We hope that inflation will follow a lower path as it will be consistent with the CPI reading. But we don't know that, and we're just going to need to see more data. So what are we going to be looking at? Really, it will be the whole broader picture. And starting with, we're looking for moderate growth, right? We're looking for supply and demand through the economy coming into better balance, including in particular in the labor market. We'll be looking at inflation, and we'll be asking ourselves, does this whole collection of data, do we assess it as suggesting that we need to raise rates further? And if we make that conclusion, then we will go ahead and raise rates. So that's how we're thinking about the next meeting, and how we're thinking about meetings going forward potentially. But we're now mainly thinking about the next meeting. I will also say, since we're talking about it, between now and the September meeting, we get 2 more job reports, 2 more CPI reports. I think we have an ECI report coming later this week, which is Employment Compensation Index, and lots of data on economic activity. All of that information is going to inform our decision as we go into that meeting. I would say it is certainly possible that we would raise funds again at the September meeting if the data warranted. And I would also say it's possible that we would choose to hold steady at that meeting. We're going to be making careful assessments, as I said, meeting by meeting. And I'll close by saying we've raised the federal funds rate now by 525 basis points since March 2022. monetary policy, we believe, is restrictive and is putting downward pressure on economic activity and inflation.
If I could just briefly follow up on something you said there. You said the data in the intermediate period, it broadly came in line with expectations. Does that mean there's unlikely to have been a change in the overwhelming outlook of the committee that 2 more hikes are necessary?
I'm just going to go back to what I said. That's the question. We have 8 weeks now until the September meeting, and all that data that I recited, we're going to be looking at all of that and making that assessment then. And it really, we did have the one good reading, and of course we welcome that, but it's just one reading, as everybody knows. And we've seen this before in the data. Many forecasts call for rates for inflation to remain low, but we just don't know that until we see the data. So we'll be focusing on that.
Gina. Thank you. Thanks for taking our questions, Chair Powell. Obviously, you upgraded the language around growth in the statement today. We've seen the Barbie movie numbers. We've seen everyone going to Taylor Swift concerts this summer. It seems like the American consumer is in pretty good shape. And it does seem like growth is sort of picking back up a little bit, or at least doing well. And I wonder, from your perspective, if that continues, if we see growth not just stabilizing, but performing well this summer, is that a problem because it's inflationary, or is it good news because it suggests that a soft landing is more likely? Just how are you thinking about that sort of trajectory?
Yeah, so I would say it this way. The overall resilience of the economy, the fact that we've been able to achieve disinflation so far without any meaningful negative impact on the labor market, the strength of the economy, overall, that's a good thing. It's good to see that, of course. It's also, you see consumer confidence coming up and things like that. That will support activity going forward. But you're right, though. At the margin, stronger growth could lead over time to higher inflation, and that would require an appropriate response from monetary policy. So we'll be watching that carefully and seeing how it evolves over time.
Neil.
Thanks, Chair Powell. Neil Irwin from Axios. So as you referenced earlier, in the intermeeting period, soft CPI, jobs reports, still strong but moderating, JOLTS looks good. So if you're data dependent, why not pause again? Why not stay on hold? Why not take another meeting off when the data was at least cutting in the direction you want to see?
So if you go back to what we're trying to do here, we're trying to achieve a stance of policy that's sufficiently restrictive to bring inflation down to 2%. At the last meeting, we wrote down our individual estimates of what that would take, and the median of that was an additional 2 rate hikes. So I would say we looked at the intermeeting data, and as I mentioned, broadly consistent, not perfectly consistent, but broadly consistent with expectations. And as a result, we went ahead and took another step. And that's a labor market that continues to be strong, but gradually slowing. I mentioned that the inflation report was actually a little better than expected, but we're going to be careful about taking too much signal from a single reading. And growth came in stronger than expected. So that's how we look at it, and so we did take that step today.
Nick Timmeros of the Wall Street Journal. Chair Powell, markets widely believe the median FOMC participants' inflation forecast from June for the fourth quarter of this year will be too high, given autos and shelter. That by September, that may warrant a downward revision in the inflation forecast of 20 to 30 basis points. Would that type of inflation progress be enough to hold rates steady from here, or do you need to see below trend growth and decelerating labor income growth to be convinced that you've done enough?
So it's hard to pick the pieces apart and say, how much of this and how much of that. We'll be looking at everything. And, we'll be looking to see whether the signal from June CPI is replicated or the opposite of replicated, or whether it's somewhere in the middle. We'll be looking at the growth data. We'll be looking at the labor market data very closely, of course, and making an overall judgment about that. It's the totality of the data, I think, but with a particular focus on making progress on inflation.
If I could follow up, last month you said there were benefits to moderating the pace of increases because it would give you more information to make decisions. Would another CPI report like the one we just had in June allow you to at least maintain that slower pace and defer until the fall any decision on whether you need that second rate hike?
So I'm just going to tell you again what we're going to do in September. We're going to look at 2 additional job reports, 2 additional CPI reports, lots of activity data, and that's what we're going to look at, and we're going to make that decision then. And that decision could mean another hike in September, or it could mean that we decide to maintain at that level. And again, the question we're going to be asking ourselves is the overall signal one that we need to do more, that we need to tighten further? And if we get that signal whenever we get it, then, and that's the collective judgment of the committee, then we will move ahead. If we don't, then we'll have the option of maintaining policy at that level. But it's really dependent so much on the data, and we just don't have it yet.
Chris.
Hi, Chris Rugaber at Associated Press. So consumer confidence in the economy is rising, likely in large part because of the declines in headline inflation. You also see wages are also rising faster than prices now after trailing them for a long time. How much are Americans truly harmed by inflation at its current level, headline level of 3%? And with that in mind, when do you put some weight back on the employment side of the dual mandate?
So I guess I'd say it this way. First, it is a good thing that headline inflation has come down so much, because that's really what the public experiences. And I would say that having headline inflation move down that much almost creates it will strengthen the broad sense that the public has that inflation is coming down, which will in turn, we hope, help inflation continue to move down. So you are really, sorry, what your question was?
Well, I mean, you've talked for many press conferences now about the harm created by inflation, how hard it is for people. So how much of that are we still seeing with inflation now down at 3%?
So I guess I would put it this way. I'd say it this way. It's really a question of how do you balance the 2 risks, the risk of doing too much or doing too little. And, I would say that, we're coming to a place where there really are risks on both sides. It's hard to say exactly whether they're in balance or not, but as our stances become more restrictive and inflation moderates, we do increasingly face that risk. But, we need to see that inflation is durably down that far. As you know, we think, and most economists think, that core inflation is actually a better signal of where headline inflation is going, because headline inflation is affected greatly by volatile energy and food prices. So we would want core inflation to be coming down, because that's what we think core is signaling where headline is going to go in the future. And core inflation is still pretty elevated. There's reason to think it can come down now, but it's still quite elevated. And so we think we need to stay on task, and we think we're going to need to certainly hold policy at a restricted levels for some time, and we need to be prepared to raise further if we think that's appropriate.
Well, and then if inflation were to, just a quick follow, if it stays at 3 or drops even a little bit more, I mean, how much of an increase in unemployment do you think is acceptable to get that last bit of inflation? People are talking about the potential difficulty of the so-called last mile of inflation. So, but how much unemployment do you think is justified to get down that last?
So it is a very positive thing that actually the unemployment rate is the same as it was when we lifted off in March of 22 at 3.6%. So that's a real blessing, and that we've been able to achieve some disinflation. And we don't seek to, it's not that we're aiming to raise unemployment, but I would just say the historical record, we have to be honest about the historical record, which does suggest that when central banks go in and slow the economy to bring down inflation, the result tends to be some softening in labor market conditions. And so that is still the likely outcome here. And, we hope that that's as little as possible. We have to be honest that is the likely outcome. The worst outcome for everyone, of course, would be not to deal with inflation now, not get it done. Whatever the short-term social costs of getting inflation under control, the longer-term social costs of failing to do so are greater, and that the historical record is very, very clear on that. If you go through a period where inflation expectations are not anchored, inflation is volatile, it interferes with people's lives and with economic activity, and that's the thing we really need to avoid and will avoid.
Michael McKee.
At this point, you say the policy is restrictive, but all year long we have seen growth surprise to the upside, unemployment to the downside, and inflation lately to the downside. So I'm wondering, by definition, should you be restrictive enough right now under these conditions? Do you think you might need to do more? Because I'm curious about what you see as inflation dynamics now. Is the economy still moving in a direction where it creates more inflation? People talk about base effects and higher energy costs, and now we have some large labor settlements. Or is the economy disinflating, and you're able to go back to the old Fed policy of opportunistic disinflation?
So I'll just say, again, the broader picture of what we want to see is we want to see easing of supply constraints and normalization of pandemic-related distortions to demand and supply. We want to see economic growth running at moderate or modest levels to help ease inflationary pressures. We want to see continued restoration of supply and demand balance, particularly in the labor market, and all of that should lead to declining inflationary pressures. Now, what we see is those pieces of the puzzle coming together, and we're seeing evidence of those things now. But I would say that what our eyes are telling us is that policy has not been restrictive enough for long enough to have its full desired effects. So we intend, again, to keep policy restrictive until we're confident that inflation is coming down sustainably toward our 2% target, and we're prepared to further tighten if that is appropriate. And we think the process, still probably has a long way to go.
Well, do you think under current conditions you are restrictive enough unless something changes?
Well, I think we think today's rate hike was appropriate, and I think we're going to be looking at the incoming data to inform our decision at the next meeting about is the incoming data telling us that we need to do more, and if it does tell us that collectively, if that's our view, then we will do more.
Colby.
Thank you. Colby Smith with the Financial Times. If September is in fact a live meeting, how does that square with the need for a more gradual tightening pace that you spoke of last month in explaining the rationale for holding the funds rate steady at the June meeting?
So a more gradual pace doesn't go immediately to every other meeting. It could be 2 out of 3 meetings, right? It just means if you're slowing down, the point really was to slow down the decision cycle as we get closer and closer to, we think, our destination. And I wouldn't want to go automatically to every other meeting because I just don't think I think it's not an environment where we want to provide a lot of forward guidance. There's a lot of uncertainty out there. We just want to keep moving at what we think is the right pace. And I do think it makes all the sense in the world to slow down as we now make these finally judged decisions. And so that's what we did. And so I think it's possible, I mentioned before, it's possible that we would move at consecutive meetings. We're not taking that off the table, or we might not. It's really going to depend on what the data tell us. That's the best we can do.
All right, guys, that's probably enough of the meeting that we've seen there. Hope that was helpful just to pull it up here, guys, just on the stream here and see what Jerome Powell had to say. I think we got the majority of kind of where he's at with things. I do want to say there's a couple things that I've been, while he was speaking, I'm looking at some setups. I do like gold on the long side. I'm looking for pullbacks. I'd like to see the dust settle a little bit more. If I do take this trade, I'll be sharing it inside of the Discord channel. Again, I do like gold longs if we can get pullbacks. I see some people also in the chat who are going back and forth on who's right, who's wrong. Honestly, don't waste your time in chats. If you have a trade plan, if you have a strategy, who cares what other people say? And if you're arguing with other people over a live chat on who's right, who's wrong, just don't do that. Save yourself the trouble. It's not worth it. If you have a trade, if you have a trading strategy and it works for you, do what works for you. Guys, don't waste your time with that. On either side of it, right? Don't entertain it, and it's just not worth it. Debating people, like comment section, don't be the guy who just can't stop commenting on things. It's just not cool. Anyways, guys, I am looking at the gold market for pullbacks. I'm personally still interested in the S&P 500 for pullbacks, but we're not really getting too much of that here at this time. It does seem like overall the reaction was pretty positive to what Jerome Powell had to say, as well as the Fed statement here today. I am still a bull on NAS, S&P, and gold, and looking to see if we get some opportunities there. So I am looking for pullbacks, but I don't see anything immediately ready. I do like I said, I think I'm probably closest to picking up a gold trade. And if I do take this trade, again, I'm going to notify everybody inside of the Discord channel. Here's 2 things for you. Number 1, if you would like to join the, if you guys would like to join the free Discord channel, I'm going to have Chandler, the producer, drop a link for us. Thank you, Chandler, for that. Click this link here, right here, guys. If you click that, it will take you to join the free Discord channel where you can see some free stuff. We have PDF downloads and stuff like that. What's up? Lots of you guys in the chat here today. That guy Biz, what's up, man? Good to see you. Hey, you know, everybody who's in the chat, again, don't fight people in the comment section. Trade your plan, do your thing. I've been doing this for years and years and years, and I didn't get here by fighting people in the comment section. Let's be honest. Anyways, again, join us inside of the Discord channel. We just dropped the link right here. Click it. And if you guys want to join the VIP version as well, we do have a couple of support staff members who are in office right now. If you guys would like to live chat with someone on our team, we're going to drop another link here. Thank you, Chandler, for that. If you send click this link to take you to a live chat support center where you can chat with someone on our staff if you have interest in purchasing our software tools, or if you'd like to join our Discord channel, the VIP version, you can ask your questions, ask for track record results, or if you would like to just ask a few questions about what the service or software that we sell offers, you can find out more information there. Thank you guys for tuning in to today's live stream. I did enjoy it, and we will be back with more content later. Have a great rest of your day. See you guys.
And that concludes today's show. Our goal at A1 Trading is to keep you up to date with the latest market coverage through our daily videos and articles. If you like our content, make sure to subscribe for more. You can get funded today up to $200K with FX2 funding. Use our code A1Trading15 for a special discount. From all of us at A1 Trading, have a great day, and we'll see you next time.